Okay, so now we're going to talk about what a stock symbol is. This is basically what you're going to type in when you're looking up a stock on Yahoo Finance or on your Robinhood app or whatever it is that you're using. So a stock symbol is a unique series of letters assigned to a security for identification purposes, and a stock symbol is used to execute trading orders. So stock symbols are often referred to as the ticker symbol, and the New York Stock Exchange listed stocks have 3 letters or less, while the NASDAQ listed stocks have 4 or more letters. And we're going to talk about those stock exchanges in a little bit, but just understand that a stock symbol is something you use to identify your stock. If you have a stockbroker that's an in-person broker, you're going to call him up on the phone and you're going to use your stock symbol to tell him what stock you're actually talking about. It's just identification purposes for that stock, so they can know what stock you're talking about and identify it on the exchange. So let's use an example here with the Coca-Cola Company. They trade on the New York Stock Exchange, and their stock symbol is KO. Another stock people know is Amazon. They trade on the NASDAQ Exchange, and that's a 4-letter symbol, AMZN. Now, here's something interesting. This is something I was just doing out of habit. I didn't know the reason for this, but I guess I had seen it done before. A lot of times I would put a $ before my stock symbol when I was writing it down. That's actually called the cash tag, and I believe that is used on Twitter to associate that tag with a stock. So it's just a way to identify that as a stock symbol on some social media platforms, but that's just called the cash tag. So if you ever see a $ in front of the stock symbol, that's why that is. So there's Coca-Cola's logo there. Obviously, everybody's familiar with Coca-Cola. If you wanted to go out there and buy Coca-Cola stock, you would call up your stockbroker, or you'd go on your trading app and you would type in the symbol KO to get to the Coca-Cola stock. Okay, so now let's talk about a stock exchange. So a stock exchange is the marketplace where securities are bought and sold, and stock exchanges connect a buyer with a seller. So oftentimes a stock is referred to as a listed stock. And in my opinion, guys, I mean, you guys can do whatever you want. I'm giving you my best advice from the years that I've, researched this stuff and been investing myself. But you should only invest in listed stocks. And we're going to go over a lot of reasons why this is. But a listed stock is a stock trading on a major exchange. And this is typically the New York Stock Exchange or the NASDAQ Exchange. So other exchanges like the OTCBB, which is the over-the-counter bulletin board, and Pink Sheets exist as well. Those of you who are familiar with the Wolf of Wall Street movie, I'm sure you know what happened with people buying stocks off of Pink Sheets. There were brokers making ridiculous commissions off them, and it was really a bad area, things that were being pawned off on investors. You still see a lot of people, looking for deals on the over-the-counter bulletin board and on the Pink Sheets, and this is a type of speculation. We're going to talk about speculation versus investing later on here, but I would stay on the listed exchanges, especially as a beginner. Now, foreign countries have their own stock exchange. For example, there's TSX, which is the Toronto Stock Exchange. So the largest stock exchange is the New York Stock Exchange. And the New York Stock Exchange is an auction-based marketplace. So specialists are actually out there on the trading floor. These are actual people, and they represent a particular stock, and then they fill orders in an auction-style format. So many argue that electronic exchanges are more efficient and reduce the spread. And the spread, we're going to talk about that later, but basically that's the difference between the bid price and the ask price, or what someone is selling a stock for and what someone is willing to buy for. So they feel that having specialists involved results in a larger spread, and electronic exchanges have less of a spread. Now, major exchanges like the New York Stock Exchange have listing requirements, and this is the number one reason why I recommend you only trade listed stocks. So New York Stock Exchange companies must have a share price above $4 a share and a market capitalization above $40 million. So now on to the NASDAQ Exchange. So the NASDAQ is an electronic exchange. NASDAQ stands for the National Association of Securities Dealers Automated Quotations, but everybody just refers to this as the NASDAQ. The NASDAQ Exchange has listing requirements as well. The biggest difference between the New York Stock Exchange and the NASDAQ Exchange is the New York Stock Exchange has a specialist representing the stock, while the NASDAQ, all of that is handled electronically, all of the orders. So basically for the NASDAQ Exchange, the stock has to be over $4 a share. If it falls below $4 a share, they risk being delisted and knocked off onto the over-the-counter bulletin board or the Pink Sheets. And as we said, a delisted stock will end up trading on an over-the-counter stock exchange, which is not a desirable place to be. Okay, so let's talk about these over-the-counter exchanges. So over-the-counter exchanges often list smaller companies or those who failed to meet the minimum listing requirements of a major exchange like the New York Stock Exchange or the NASDAQ. So major exchanges have high liquidity, which is not a characteristic of the over-the-counter markets. So what I mean by liquidity is when there is high liquidity with a market, there will likely always be a buyer when you're looking to sell, and there will likely always be a seller when you are looking to buy, because this is a very actively traded stock. Because most people are trading on the major exchanges, it has much better liquidity. You do not see good liquidity on these over-the-counter exchanges, and that is a big problem that you can run into. So many people are interested in penny stocks, and I'm hoping to deter you from being interested in them with this course here, because they are not glamorous. They are not what they are painted out to be, and unfortunately there are a lot of very shady characters out there that are recommending people invest in penny stocks. And really, I don't think penny stocks have any business being in your stock portfolio. But we're going to get into that a little bit later when we talk about investment vehicles. But new investors should stick to the listed stocks on the NASDAQ or New York Stock Exchange. Avoid these over-the-counter stock exchanges. Really, they're nothing for beginners to get involved with. Okay, so the first over-the-counter exchange is the OTCBB, or the Over-the-Counter Bulletin Board. Now, the OTCBB does not have a minimum listing requirement, and as a result, they often carry less desirable companies. That's a very nice way of saying they carry the dog shit, okay? These are companies that most investors would not be interested in for a number of reasons. You have to think there's got to be reasons why they're not able to remain listed on a major stock exchange. So stocks trading off major exchanges often have poor liquidity. So as a result, you may not have a buyer on the other end when you are ready to sell, and there may not be a seller when you are ready to buy. So imagine if you're in a situation like that where, let's say you do decide to buy a penny stock, you do decide to invest in a penny stock, and you pick up 20,000 shares, and all of a sudden, the share price is up, and you go, oh, fantastic, time to sell my position. And you go on your trading app, and you execute the order, and it just sits there, and it sits there because nobody is ready to buy. There's poor liquidity on the over-the-counter bulletin board and over-the-counter markets, and as a result, even though you want to sell, you may not be able to. So that's typically not going to be a problem on a major exchange. So that's one of the biggest reasons I say stay off of the over-the-counter bulletin board and these over-the-counter markets. Okay, next we have the pink sheets. This is another type of over-the-counter trading. There is no minimum listing requirement with pink sheets, and the companies are not required to file with the SEC. That should be a big red flag to you. Obviously, companies on the major exchanges are required to file quarterly with the Securities and Exchange Commission, but on the pink sheets, they are not required to file. OTC bulletin board companies, they are also required to file with the SEC, so the pink sheets are the worst of the worst. This is even worse than the over-the-counter bulletin board stocks because these companies don't even have to file with the Securities and Exchange Commission. Over-the-counter stocks typically trade for a few cents a share, giving them the name penny stocks. However, if you look at the SEC defined definition, they call a penny stock any stock trading under $5 a share. I guess it depends on what you see as a penny stock. I tend to talk about penny stocks as stocks that are, 99 cents or below, something along those lines. But you'll often see stocks trading for a fraction of a penny on some of these over-the-counter exchanges. So the biggest things that you need to know about over-the-counter stocks is that they are high risk and they are very volatile stocks. So volatile means they are very erratic. There's a lot of explosive price movements, multiple percentage price swings, even on a day-to-day basis. And another huge problem with this is that these stock prices can be manipulated.